Yeah. So today we're going to start with just a quick kind of check-in question. We'll break you out into small groups and have you chat with a few other people that are in the cohort. Then Lawyers for Good Government is going to give a presentation on some legal considerations when entering into a virtual power purchase agreement. Then there will be some time for Q&A with Lawyers for Good Government. Next, we'll cover some accounting considerations when considering entering into an aggregated VPPA or physical power purchase agreement. And then we'll end with small group time. You'll have about 30 minutes within your procurement group to discuss some of the legal and accounting things that you heard and discuss any concerns you might have and do some group alignment around what kind of are your next steps. And then we'll wrap up. So for now, oh, I guess I should also say, I just want to give a kind of shout out to Bloomberg Philanthropy. They are kind of the reason that we're able to provide this free technical assistance. So thank you for their support in making this cohort possible. All right, so we're going to have just a 5-minute check-in. You'll be randomly grouped with 2 other people. And in this check-in, I just want you to say your name, your organization, and what your goal is for today's workshop. So what do you hope to leave this workshop knowing that you maybe didn't know going in? So I want to just kind of start with a high level zoom out. We've talked about kind of the aggregation process, and you've now read the aggregation procurement guidance document, and we kind of went through this in a lot more detail during the last meeting. But just to walk through it again, kind of the first step is to assess the procurement needs. And so legal and accounting is really important to understand if you are able to actually participate in these types of contracts for yourself. So like, are you able to legally enter into a virtual power purchase agreement? That's pretty key to understand before kind of moving forward with partners. The next step is forming a procurement group. And so again, once you have your own internal knowledge of whether you can move forward, then you need to kind of coordinate with your partners to figure out kind of where you have gaps and where you need to align. Then aligning on the desired project details. This includes legal and accounting considerations. And these considerations could include thinking through kind of timelines for authorization and making sure if one partner has a really long timeline, making sure that they're starting that authorization process sooner. And also you have to think about it when bringing in new partners. If you're bringing in a new partner at the last minute, but you know they have a really long authorization timeline, then it might not make sense to bring them in. So thinking through kind of these legal and accounting considerations early on will be really important to be able to successfully procure as a group. As you, Mia, feel free to just kind of click through the rest of these. I'll just go through them really quickly. But so after you've aligned on the desired details, we'll pitch to senior leadership, and you'll kind of need to know, need to have some of these answers to legal and accounting when you're making kind of that final pitch. Selecting suppliers and projects. Legal considerations are very important when thinking through developing the RFP, negotiating and signing the contract, and then sharing your story. So where we're at in the process right now is still really kind of step 1 and step 2, and kind of step 3. So making your own internal legal and accounting decisions and then working on them as a group. So we are lucky to have Lawyers for Good Government with us on the call today. And largely I'm going to hand it over to them to give this kind of legal presentation. But Mia, feel free to go to the next slide. So we have Zach Cedar on the phone. He's a principal at Zach Cedar Legal and a volunteer for Lawyers for Good Government. He's been an attorney for over 13 years and has experience across all aspects of the renewable energy sector. He works closely with developers and owners of renewable energy projects, as well as banks, funds, and other capital providers active in the space. We also have Jillian Blanchard, and she's the managing partner of Rudder Law Group in California and the director of Lawyers for Good Government Climate Change Policy. She's been a natural resources and energy attorney for over 20 years and works closely with developers, utilities, and municipalities on environmental and land use approval, as well as a variety of public agency contracts. So how they kind of fit into this, through American Cities Climate Challenge, we work directly with some cities that were considering entering into virtual power purchase agreements. And because not very many cities have done this before, there is a real legal question of whether this is even possible. So Lawyers for Good Government looked into a few specific cities for us in order to kind of see what the legal considerations and concerns might be in entering into this type of a contract. And from that analysis, there were a few kind of overarching takeaways that that we felt like could kind of span across different states and cities. And there were a few that were very state and city specific. But in terms of kind of some of the overarching takeaways, we took those memos and developed that legal memo that we shared with you last meeting. And so that's kind of how we've been, how Lawyers for Good Government has been supporting this process to date. And I will allow them to kind of, I'll pass it over to them now to talk a little bit more about kind of what the process looked like that they went through to think through legal considerations. And as they're presenting, feel free to type questions into the chat. We'll have 10 minutes for questions at the end, but we'll let them kind of get through their whole presentation before we stop for questions. So at this point, I'll pass it over to Zach.
Okay, thank you, Elisa. Hello, everyone. So I'm Zach Cedar, and with Lawyers for Good Government. And as Elisa said, we're going to walk through the analysis and some of the conclusions we drew in looking at this issue. So I don't know, Elisa, do you want to move to into the next slide? Disclaimers. Yes, this is not legal advice. And of course, every state and every jurisdiction is different. And so we're going to lay out some general principles, but none of this should be construed as specific legal advice. Okay, I think we covered that. Okay, so starting with the basics here, we're talking about virtual power purchase agreements. So it's really a financial product, as I'm sure everyone knows. It's not limited by the same types of regulatory constraints that may apply to physical PPAs. It can be done in regulated markets where there's not retail deregulation, and it doesn't require FERC approval or FERC power marketing license, which makes it very versatile and a good tool for all types of different jurisdictions. Okay, I think we can move to the next slide. Okay, so in this analytical process that we go through, we're really stepping through this, in terms of how we approached it. And the first step is really to determine whether municipal government has the authority to enter into a VPPA, or really to act in a discretionary manner without express specific authority from the state to do these things. So, and this generally falls into the categorization as either Dillon's rule state or home rule state. As a starting principle here, municipal governments and entities have no separate authority outside of state law. So by default, municipal governments can only exercise the authority that has been granted to them by the state, which is generally known as Dillon's rule. But in some states, the state has delegated blanket authority or broad authority in certain areas to local governments, either through constitutional provisions or by statute. And that generally comes in the form of home rule statutes or home rule constitutional provisions that allow governments to take actions that are not expressly prohibited or preempted by state law. So the analysis does turn on making a determination as to whether the jurisdiction is either a home rule or Dillon rule jurisdiction or something in between, because it's not an entirely clear distinction. There are hybrid models that involve a little bit of both. So the first thing you need to do is make that determination. And if we're dealing with a Dillon's rule jurisdiction where you do need to find express authority at the state level, then that raises a different set of considerations. You really do need to look very carefully at the state statutes and see if you can identify an appropriate source of authority for a contract like this. It's not likely there'll be anything that mentions VPPA specifically, since not many have been done in this context anyway. So that might be a bit more challenging. In a home rule context, it's more an exercise in identifying any potential obstacles, something that would prohibit a local government from doing this. And so here we have some of the states that are of interest today and what their systems are. This is a pretty generic description. So I would encourage people to look into this more carefully, and particularly for those where Dillon rule is cited as being the predominant form of the predominant system, I think looking for that express authority that I mentioned is going to be an important step there. So we can move on. So that's the first step. So now, and really from here, we're going to assume for purposes of the rest of the analysis that we've identified, or that we have an appropriate grant of authority for municipalities or for municipal government to move forward without having an express statutory authority for this type of contract. So then we move into an analysis of what roadblocks may there be at the state level that may prevent a VPPA. And the first one that we're going to hit on are constitutional limitations. This would be limitations that come from principles embodied in the state constitution. The most common one would be the public purpose doctrine, which generally is the concept that public funds need to be spent for public purposes, or to say it another way, that public funds can't be applied for private purposes. You'll often see this expressed in the section on taxation and finance in the Constitution, and there's generally a lot of case law that also will apply here that needs to be reviewed. It doesn't generally operate as an absolute bar to the receipt of public funds by private interests, obviously, because this is pretty common in the context of economic development projects and related legislation. But I think, and this is a generalization across jurisdictions, but generally, if you have a use that's incidental, or a private benefit that's incidental to the pursuit of a public benefit, the courts will give that significant deference, will not tend to overturn that on constitutional grounds. So it makes it important to establish that the purpose of this is not, of a VPPA, is not to enrich a private developer or to make payments to a private developer, but to achieve a public benefit. And in order to do that, you're entering into a contract that does have incidental benefits for a private entity, because you are making payments to a project in order to support it financially. So that's an important theme to be consistent about in the way that these contracts are framed. Okay, next, yeah. So now from there, we move on to more specific statutory limitations that may apply. And here there's a couple areas that tend to come up in various jurisdictions. And one is treatment of a VPPA as a debt obligation. So with respect to these statutes that address debt obligations, these typically apply even in home rule jurisdictions as limitations on what municipalities can do. It's something that's controlled pretty closely at the state level almost everywhere. And the issue that you may have here is that even though a VPPA is not debt in the conventional sense, it does create future obligations, future payment obligations, and that may be picked up by the definition, the statutory definition of a debt obligation. Usually that definition takes the form of a broad definition that references future obligations and then has a number of enumerated exceptions to that definition. I doubt you're going to find an exception that says VPPA, but there may be others that are close. There may be, for example, exceptions that reference supply contracts, exceptions that reference interest rate swaps, which is a similar financial product to a VPPA in many ways. So there may be good precedent for making the case that a VPPA falls into or is similar to other exceptions that are available, but it's an area that you need to look at pretty carefully, because if it can be characterized as a debt obligation, then there's a lot of limitations and regulation that will then come to bear. And then the next one would be in the statutes that regulate investments by municipalities, and these generally apply to funds that are sitting in an account and where those can be invested. And usually the rules are pretty conservative with respect to the investment vehicles that can apply. I don't think I would expect in any case that a VPPA would qualify as an acceptable investment vehicle. But the point here is that a VPPA is not an investment vehicle. It's not being used as a means of generating returns, or it shouldn't be primarily, although it is of course possible, depending on market conditions, that will happen. But it shouldn't be approached legally as a method of investing funds for return. It's much more sound to view it as a public purpose expenditure that's being made. And one other point on the investment concept is that so with VPPAs, you may have credit support requirements both for the seller and the buyer. And if you have a credit support requirement that applies to the buyer, which requires cash collateral to sit in an account that's dedicated and sequestered for this purpose, that may bring you a little closer to what's regulated by an investment statute. So not necessarily, but it may be better to avoid structures like that. And then, although it's not on the slide, one other point I want to hit here is that, and this is not at the state level, but you should also make sure to look at the charter of the home rule jurisdiction, if it is one, because there may be similar requirements in there that need to be taken into account. So that would be the last step in this process. Okay, so now here we're moving from an analysis of whether there's an obstacle at the state level to how do you properly establish authority at the local level. And it may or may not be strictly necessary to enter into an ordinance or resolution, depending what type of authority is provided by the charter or the municipal code. But in any case, it's probably a good idea to do this for the reason that it will provide clear express authority, and it will also, so it puts the legal analysis on firmer ground, and it also provides you an opportunity to elaborate the legal rationale for the VPPA, to make it consistent with the kind of considerations we've just gone through, to frame it appropriately, and also to cover some of the commercial parameters that you may want to include in there, that things like maximum limitation on liability, or what type of counterparty credit, or other significant commercial considerations that you may want to build in, and that will provide certainly a basis for negotiating with counterparties. For one, will be, it will tend to, I think, it's a little harder to move off of those if they're part of an ordinance. And I think it also just provides for uniformity and an ability to clearly state what approach you're taking legally. So it's so this is something that we recommend in most cases. And one of the sources of precedent, one of the models you may want to look at when thinking about an ordinance or a resolution are similar ordinances that have been put in place or sometimes state statutes that address interest rate swaps or other swaps because they're very similar financial products, as I mentioned earlier. And so you often find detailed statutes that address these, what they are, how they're properly characterized, and what sorts of parameters apply. And so that can be a useful source of ideas in drafting similar provisions that apply to VPPAs. Okay, so now moving from kind of a strictly legal analysis as to what can and can't be done into a more practical view on what type of contract can actually be performed effectively. Here you get into, I think, primarily the consideration that I would look at here is how municipal budgeting works and appropriations, particularly the need that expenses be appropriated a year in advance. This can be a challenge with a contract like a VPPA, which by its nature is variable. It varies. A typical VPPA each quarter or each month the settlement price, payable to or from the seller, would vary with the wholesale energy market price. So that can be a difficult thing to manage if you have a very rigid budget to deal with. So I think our recommendation in this case for the best way to manage it is to incorporate concepts into the contract that provide for more predictable payments. And some of the examples are on the slide here, things like a longer settlement period or a price floor or a collar, as it's called, which would put kind of a range around what kind of, how much the maximum payment could be. Other ideas that you might want to consider are things like tracking accounts for carrying over excesses into future budget periods. And I think one point I'd like to highlight here is that all these types of mechanisms, and you can get creative with what they are to suit your needs, but it will be effective to communicate these early in the process, particularly as part of the RFP, because that way a counterparty can take that into account in their pricing. These are significant commercial points. I would expect them to have an impact potentially on pricing and other commercial considerations. So it will be better to flag these early in the process so you get accurate bids that reflect what you're looking for. And then the last point is this is really a reference to a particular transaction with Arlington County in Virginia, where this was done through a utility. And in that case, so this was not a third-party VPPA, to be clear. This was done through the local utility. But it did include some features like the ones I've just described, in particular having an annual forecast budget and then a true-up mechanism. So it did include ways of smoothing out these payment obligations that may be useful to look at as a precedent. Okay, so on procurement, I understand this is the topic of a separate session, so I won't go into too much detail here, but of course there are typically a lot of procedures that apply that need to be conformed to in the procurement context. And in terms of what's being procured here, I would say it would probably be the environmental attributes themselves, because another way to think about a VPPA is as a purchase agreement for environmental attributes or RECs. But I'll leave that for another session. And then I think the last thing that we wanted to touch on are just the federal considerations. Since a VPPA is a swap, it is subject to Dodd-Frank, but fortunately does not trigger the more onerous requirements. Clearing, margin, registration are not things you need to worry about generally. Reporting is something that is typically allocated to the seller in a VPPA. So as long as you take that position, shouldn't be a significant burden. And that leaves record keeping, which boils down to a requirement that records be maintained and be available. So that shouldn't be particularly burdensome if that's already something that already a practice that you have. So that takes us to the end, and feel free to shoot any questions our way. And again, this is meant to cover the general process that we've applied across jurisdictions. It's not specific to any particular jurisdiction. So, but feel free to reach out to us if you'd like to have any more detail on these points.
Thanks so much, Zach. Amazing to have Lawyers for Good Government on the call. I can't imagine presenting all that legal stuff myself. So let's take advantage of having kind of this expertise on the call. I'm going to kick it off. I saw we got a few questions kind of during your presentation. I'm sure there will be more to come. But Carol, I'll actually let you unmute and ask your question to Zach.
Yeah. Thank you. I think I had several related questions. It seems that you all are indicating that Virginia is the most strictly Dillon's rule state. And so we are the most constrained in pursuing a VPPA, unlike the sleeved version that Arlington pursued. My first question, and maybe this is more a question for the RMIWRI team, does it make sense for us to pursue enabling legislation in the next General Assembly session? Probably not a question we can answer tonight. I was just throwing it out there. But it looks like John and I had a similar question about this public purpose doctrine. And I didn't track that because it seems like almost any business we do with any contractor would by definition benefit a private entity, whether it's a road paver or whoever. And I don't understand how this wouldn't be similar.
Sure. So I can address that. Yeah, I think, I don't know if it would apply in every context. If you're procuring services, that's a little different than making a payment to induce, a particular action. But it certainly is something that tends to come up in a lot of contexts. And as I said, it's not an absolute bar by any means to making payments to a private entity, because that wouldn't make sense. But in this case with a VPPA, I mean, you really are entering into a contract for differences with a private entity that requires you to make payments to that private entity to support the economic viability of their project. I mean, that's fundamentally what it is. And the purpose of it is to allow them to build that project, to give them the financial security that they can go raise capital around that project. So, I can see it coming up. If, I don't know if anyone's going to take that position, but I can see it coming up and being kind of a valid position and requiring that it be framed correctly and have a proper record.
Yeah, and this is Jillian. I can add on to that if you like. I think we raise it mostly, Carol, because we just want to make sure that it gets covered. Not that it's going to be a bar, but certainly if you're identifying state authority that maybe needs to be tied to a public purpose, if you are wanting to, pass an ordinance that needs to be tied to a public purpose, some constitutions limit your ability to provide a private benefit. And so to the extent someone tries to define it as Zach said, helping this entity build their project, having that public purpose clearly laid out in terms of environmental benefit will just serve to protect any potential challenges. If there happens to be a utility who's interested and wants to challenge that effort, you will be just more protected. So it's not really a bar, it's just kind of things to consider.
So I don't want to monopolize, but let me follow up on that question. So would the public purpose be significantly bolstered by either the governor taking a position on, renewable energy transition and having explicit goals and recent legislation to support that, and or if your locality has a long history of having long-standing climate or other environmental goals that would be advanced by this, are both of those helpful? I think they're obviously helpful. Yeah. I just don't know how to whether just passing an ordinance declaring this is for a public purpose for these reasons for state and local, to meet state and local objectives.
Yeah, no, I think that you're absolutely right. Having, state authority to point to where those objectives have already been identified is extremely helpful, not only to protect your VPPA, but to also to identify your state authority, express authority. So I think it's helpful to flag both of those if they exist.
Can I jump in for a second?
Yes, go ahead, John.
So thanks. I think some of this might, in the Virginia case, might be addressed by the fact that the state government itself has entered into these agreements, both through the University of Virginia and then state agencies themselves. Basically, the governor has said, hey, we're going to do these deals. Now, the catch is that they've all been with Dominion, the utility. And Arlington did it. We did it through the utility. And so I think the key thing for whether it's making it explicit in General Assembly legislation or through some other directive is that these kind of arrangements, not necessarily with the incumbent utility, are legal. Because the other kind of catch is that in Virginia, utility transactions for local governments tend to be exempt from a lot of the rigmarole of Virginia procurement. The idea being that, well, these things are just flat out necessities that are, we need for operations. And I think it was in large part that arrangement we have with our utility that gave our county attorney the confidence of just plowing forward. So it goes to the whole notion of doing this kind of a transaction, not necessarily, with anyone, not necessarily the incumbent utility. But then I think the notions of public purpose, and this is just a contract for renewable energy credits, basically. And yes, on the one hand, the assurance of the contract provides a benefit to the developer in the sense that they can go forward and build the thing. But ultimately, the goal is for the payments to be net to the buyer.
Thanks, John. So we're running out of time for questions. I saw we had a question from Rosie, so this will be the last question. But as you can see on the screen, there are emails here for both Lawyers for Good Government and Zach. And so you can feel free to either send them emails or send me emails, and we can continue to support this conversation. But for now, Rosie, feel free to unmute and ask your question.
Yeah, I just wondered, so I'm not a municipality, I don't represent a municipality, I represent Dartmouth College, but we work very closely with the municipality of Hanover in which we reside. And I wondered if there was a way that a sort of, I guess it would be a public-private partnership of some type, that if our private entity, nonprofit college, could provide a structure that would help our municipality navigate around some of these complexities, or smooth out some of the bumps on the road and make it easier for them to enter into a VPPA. Maybe that's too specific, but I kind of wonder, maybe it's generalizable in the sense that probably every municipality on this call has some private entity, a business that's a large scale energy consumer within their city limits or something that could potentially be a partner or a party to the contract. And I wondered if that has any advantage in terms of how you structure the contract to enable the municipality to navigate some of these things.
That's a good question. I don't know, Jillian, if you have thoughts. I can't offhand. Certainly these issues are specific to the municipal context and would not apply to a college. Whether there's a way that the college can become involved and address some of these issues? I can't think of any offhand, but I'll give it more thought. I don't know, Jillian, if you have other.
Yeah, I mean, I'd probably want to think about it further and, just see how Dartmouth College is structured. But the one thing that might come to mind is just with respect to ways to mitigate budgeting challenges. So for example, if Dartmouth College has more flexibility in terms of what types of obligations it can take on, whereas a city or municipality might be limited in terms of what it can, its budgeting constraints annually, that might be something that if Dartmouth could handle the overflow or something. But again, you got to look at the specifics to see if it works with that municipality, if they're even able to pass that off to a private entity. So there's lots of logistics to it, but that's just one thing that maybe comes to mind.
Thanks, Jillian and Zach. So at this point, Jillian and Zach are going to jump off the call. Thank you so much for your time. We really appreciate it. And as I mentioned before, they are happy to answer additional questions as they come up. But thank you both, and we'll be in touch soon.
Yeah, thanks everyone.
Okay, thanks everyone.
So at this point, I'll pass it over to Mia, who will start talking about some aggregation accounting considerations. And again, feel free to just type questions in the chat box as they come up, and we'll have some time at the end to answer those.
Great, thank you so much, Elisa. So I'm going to give a short presentation right now talking about some of the key accounting considerations that procurement groups will need to address. And our main top line recommendation is that procurement groups do need to align on accounting considerations. This is because the PPA contract terms and language used will determine which accounting method each buyer needs to use. Local governments and public institutions use the Government Accounting Standards Boards have different accounting rules than private corporations or institutions that use FASB or the Financial Accounting Standards Board. Like I said, the same contract language can actually result in different accounting treatments for public and private buyers. Designing a PPA to use accrual accounting can ease accounting treatment because it avoids the need to conduct mark-to-market accounting or consolidate an asset on your organization's balance sheet. That being said, it's important to align on these considerations before issuing an RFP, but also be mindful that if you are currently a group of primarily public entities, but you are thinking about inviting corporate partners to piggyback or join your deal later on, you should be mindful that they have different accounting treatment for PPAs than public buyers. As I said, these different entities have different accounting rules. State and local governments, school districts, other public institutions that are publicly owned are managed by the Government Accounting Standards Board. Whereas private institutions, nonprofit organizations that follow GAAP accounting, or other privately owned institutions and companies will use the Financial Accounting Standards Board. Local governments have much simpler accounting rules when it comes to PPAs and VPPAs than corporations. This is based on conversations that RMI had with GASB staff earlier this summer. And we've determined that for the kind of 3 types of accounting treatment that people might want to avoid, there is VI consolidation accounting or variable interest entity accounting. And this is not used in GASB, which is great. There is lease accounting. And for leases, under GASB, physical power purchase agreements are explicitly excluded from lease accounting. And VPPAs, while in a bit of a gray area, they might be excluded. If not, they can very easily avoid lease accounting by not providing cities with the right to control an asset. And finally, derivative accounting. PPAs and VPPAs can be exempt from it using the normal purchases, normal sales exception under GASB. And I will go into all of these in more detail. So for GASB lease accounting, GASB defines a lease as a contract that conveys the right to obtain the present service capacity from the use of an underlying asset and the right to determine the nature and manner of the use of the asset. The good news is physical PPAs are explicitly excluded under GASB because GASB excludes supply contracts such as power purchase contracts, So for physical power purchase agreements, whether you're purchasing 1% or 100% of the output, you do not risk triggering lease accounting. Virtual power purchase agreements might fall under the same supply contract exception, but ultimately that's going to be up to the determination of GASB, your city accountant, or your auditor. The good news is, if VPPAs are not excluded as a supply contract, the only way that they could still trigger lease accounting is if the contract gave the local government the right to determine how the renewable energy asset is used by dictating when, how, and how much energy it can produce. This language is not common in VPPAs or PPA contracts, so it's very easy to avoid. For derivative accounting, similarly, electricity contracts, whether physical or financial, are excluded from the scope of derivative accounting using the normal purchases, normal sales exemption. The normal purchases, normal sales exception has three main indicators. The government has entered a similar contract in the past. They have the practice of taking delivery of that commodity, and if the quantity of the commodity is consistent with the government's activities. And so it's very, very likely, or it's the guidance of GASB, that under this exception, governments, whether they're doing physical power purchase agreements or virtual power purchase agreements, can opt for this exemption. One thing to note is because the NPNS exemption does ask that governments are purchasing a volume consistent with your activities, you might not be able to do this if you plan to purchase significantly more than you consume. And finally, once this exemption is opted for, it cannot be undone. Corporations and other entities that use FASB have different accounting rules than local governments. And the final contract terms and language are going to inform which accounting approach is necessary. Procurement groups that are planning to have a mix of public and private entities will need to put in special consideration to align on these accounting treatments early on. So as I mentioned, governments are exempt from by consolidation accounting, but that's not the case for under FASB. So for a corporation, if they were contracting with a special purpose vehicle, they can avoid by accounting by ensuring the seller contains the right to control the facility. Special purpose vehicles are subsidiary entities that are created by a parent company to isolate financial risk. And this is fairly common in the renewable energy industry, where large renewable energy projects will be set up under a special purpose vehicle. The second is lease accounting. For virtual power purchase agreements, lease accounting can be avoided, and for physical power purchase agreements as well, can be avoided by purchasing a portion of the total output from the facility. And guidance typically says that less than 90% of the output is okay. So if you have an anchor off-taker that is planning to procure a much larger percentage of the output, there is a chance it could trigger lease accounting, but this can be avoided if they purchase less than 90% of the output. And finally, for derivative accounting, physical power purchase agreements under FASB can opt for the normal purchases, normal sales exception. However, unlike for governments, corporations who pursue virtual power purchase agreements can avoid derivative accounting by purchasing a percentage as opposed to a fixed amount of output. They cannot use the NPNS exception. However, this handy workaround by saying that you'll purchase, for example, 10 megawatts instead of the fixed 900,000 megawatt hours gets around derivative accounting. And so just to kind of summarize here on aligning on these accounting considerations, what do you and your groups actually need to pay attention to? So individual buyers should look at what type of accounting treatment your organization is open to. This might be accrual accounting, but it also might not be. For corporate buyers and nonprofit buyers that use FASB, this question is the most important because it is potential that you might have to do one of these other forms of accounting treatment. Groups should consider if they have multiple types of buyers with different accounting needs. And as I've mentioned, if your group right now is purely local governments, but you do plan to invite corporate buyers to piggyback later in the deal, it is important to be mindful of these different accounting rules for corporate and nonprofit buyers. And then groups should ask, what is the associated contract language to facilitate the designated accounting treatment? Are buyers okay purchasing a percentage, not fixed amount of output, for example? While these accounting rules may be complicated, the very nature of aggregation does simplify them. And so to reiterate, it's very unlikely that an aggregated group will trigger lease accounting because each buyer is already purchasing a portion of the output. And derivative accounting can be avoided by purchasing a percentage, not a fixed amount. And so while government entities do not have to worry about these complicated accounting treatments, there are fairly simple fixes that groups can align upon in order to accommodate corporate buyers who might have more complicated accounting treatment. That was a very, very quick rundown of accounting considerations. We are going to be taking your questions in the chat, and we will also provide information later in this presentation about how you can submit your questions directly to GASB. But for now, we're going to move into individual procurement group discussion. And Elisa, do you want to kick that off?
Do you want to unmute and ask your question?
Sure, I might not mistype if I speak. So the scenarios that were presented, I think, contemplated non-local governments looking to bring in a corporate or private entity into the buyers group. And I guess I'm curious if in the reverse you had one or multiple private sector buyers looking to bring in a local government partner into the purchase. Would they would then have set up their language to meet their FASB parameters, then what, right? Because then it's kind of would be a foregone kind of conclusion that their arrangement would not make it very feasible to join in, or if there are particular components that we should look out for in that configuration. Is that a clear question?
Yeah, that's a clear question. It's a good question. My understanding is that, so FASB has stricter requirements than GASB. And so if you are following the FASB requirements, you will naturally meet the GASB requirements. So it's really like the local governments, when it comes to accounting issues, don't complicate accounting. Only kind of adding in corporations could complicate accounting.
Okay, that's clear. Thank you.
Okay, great. John, I saw you raised your hand.
Yeah, thanks. So I had asked the question to some other folks that I was dealing with in Arlington on if there were that private entity that, say, wanted to be an anchor. From a procurement standpoint, could we just glom on to their vehicle, or would the contract vehicle need to be led by a government agency? And our procurement said, yeah, if the government's going to buy something, it has to be through a government procurement process, and the private entity could participate if they wanted. I'm not thinking about the accounting aspect, but I'm just curious whether other states might have a similar thing. If the private entity is looking nationally, whether we're all in the same boat of the public agencies have to follow a public procurement process for any kind of aggregation, and not just ride on to a private company's led procurement.
Yeah, I think that's a really important question to flag, and something I think we'll plan to cover a little bit more during the next session where we're talking about procurement process. But that's certainly a question that we would encourage everyone to kind of go back and ask their procurement team about, especially if you're thinking about partners that are not local government partners. Are there additional considerations that maybe you didn't initially think about? And if only a local government is allowed to issue the RFP, that obviously changes to some degree potentially the governance structure that you select. It could change who you are having lead the procurement. And so these are the kinds of conversations that are really needed to move the idea forward. So thank you for flagging that. And yeah, we'll talk about that more next meeting.